If you have $5,000 to set aside for a child or grandchild, where should it go? A Trump account, a 529 plan, or maybe a Coverdell? At first, this sounds like a simple comparison, but it really isn't, because one account is mainly designed for retirement and two are mainly designed for education. And the best choice depends on what you actually want the money to do. In this video, I'm going to break down from a tax planning perspective these plans. I'm not an investment advisor, so I'm not going to tell you which fund to buy or which account will earn the highest return, but I can explain how each account is taxed, what the money can be used for, and where that first $5,000 may make the most sense to go. And if you find this helpful, please like the video and subscribe to the channel. So let's start with the Trump account. The easiest way to think of a Trump account is this. It allows retirement money to be set aside for a child before that child has any earned income. You see, normally you have to have earned income to contribute to a IRA. A Trump account changes that during the child's early years. Parents, grandparents, friends, and even an employer may contribute to a Trump account. For 2026, the total regular contribution limit is $5,000 per child, and that will increase each year for inflation. And this is important. That is $5,000 in total. It's not $5,000 from grandma, another $5,000 from grandpa, and another $5,000 from the parents. Everyone's regular contributions are added together. An employer may contribute $2,500, but that amount is included in the $5,000 limit. So if an employer contributes $2,500, the family could generally contribute another $2,500. Some children may also qualify for a one-time $1,000 federal contribution. That $1,000 does not reduce the $5,000 regular contribution. So if a child qualifies for the $1,000, opening the account is probably an easy decision. The more difficult question is whether the family should put an additional money into the Trump account or use a 529 in plan. And the strongest argument for a Trump account is time. So let's say that a family contributes a $5,000 at the end of the year for every year for 18 years. That is a total of $90,000. If the account earns an average of $5,000 per year, it could be worth about $140,000 when the child turns 18. Now let's say the child doesn't touch it. No more contributions, it just stays invested until age 65. At that same 5% return, it could grow to roughly $1.4 million. That is why the Trump account has many people paying attention. It creates the possibility of starting retirement compounding before the child is even old enough to work. Of course, 5% is only an illustration. Returns are not guaranteed, and the account would not automatically be tax-free, but the amount of time involved can be extremely powerful. Now, what happens when the child turns 18? Beginning January 1 of the year the child turns 18, most of the special childhood restrictions end. The child could leave the money in the Trump account, they could transfer it to a regular traditional IRA, or they could convert some of it to a Roth IRA. That Roth conversion option could be extremely valuable. For an example, an 18 or 19-year-old may have relatively little taxable income. And by the time that they are out on their own, they could still be in a low tax bracket. That could create an opportunity to convert some of the account to a Roth account at a lower tax rate. But the taxable portion of the conversion would still be included in income. So this is not automatically a tax-free conversion, but it may be something to do over several years instead of all at once. The child could also take the money out after the growth period. And this is where I think some of the marketing around the Trump accounts may become a little bit confusing. You may hear that the money can be used for education, a first home, or even to start a business. That is technically true, but you can use the money is not the same as saying the withdrawal is tax-free. For education, the child may be able to avoid the 10% early withdrawal penalty. There is no separate fixed dollar or cap amount for education. The amount that avoids the penalty is generally limited to the qualified higher education expenses for that year. So, for example, if the child has $40,000 of qualified educational expenses, they could potentially withdraw $40,000 without the 10% penalty, but the taxable portion of that withdrawal would still generally be taxable as ordinary income. For a first home, up to $10,000 over the child's lifetime may qualify for an exemption from the 10% early withdrawal penalty. Again, the taxable portion is still generally taxable. And what about starting a business? The child may take money out and use it for a business, but there is no special business startup exemption. So before age 59 and a half, the taxable portion could be subject to both income tax and the 10% penalty. But we'll have to see as time goes on because they're still working out the rules for the Trump accounts. The education and first home exceptions are not special benefits unique to the Trump account. They're actually normal IRA rules that generally apply after the Trump account growth period ends. Now let's compare the Trump account with a 529 plan. A 529 plan is primarily an educational account. You contribute after-tax money, the account grows without current federal income tax, and when the money is used for qualified educational expenses, the earnings can generally come out tax-free. That's the biggest advantage of a 529, that the funds come out tax-free. Here's the difference. With a Trump account, an educational withdrawal may avoid the 10% penalty, but the taxable portion may still be taxable. With a 529 plan, a qualified educational withdrawal may be completely free of federal income tax. So let's use an example. Suppose a grandparent contributes $20,000 to a 529 plan. Over time, it grows to $35,000. If the full $35,000 is used for qualified educational expenses, the $15,000 of growth may come out tax-free. That is a stronger educational benefit than the Trump account provides. And a 529 is not limited to traditional four-year college. It may cover eligible college expenses, graduate schools, vocational schools, credentialing expenses, and limited student loan payments and eligible K through 12 expenses. State tax treatment may not always follow federal rules, so that needs to be checked as well. Now, the biggest concern people have with the 529 plan is what if the child does not go to college, or what if they don't use all the funds in the 529 plan? That doesn't mean that the money is automatically lost or immediately penalized. The money can stay in the account. The beneficiary may change to another qualifying family member, and a limited amount may potentially be able to be rolled over to a Roth IRA for the beneficiary. That rollover is subject to several conditions, like the account generally must have been open for 15 years. The beneficiary generally needs sufficient earned income. The Roth IRA contribution limits also apply, and there's a $35,000 lifetime rollover limit. So you cannot automatically move the entire 529 balance into a Roth IRA, but it does give family members options if the account ends up being modestly overfunded. Now, let's briefly talk about this Coverdell Education Savings Account. The Coverdell is also an educational account. Qualified withdrawals can generally be tax-free, and depending on the custodian, it may provide broader investment choices than a typical 529 plan. But there are some major limits. Total contributions from everyone are limited to $2,000 per child. There are also contributor limit on the income and age restrictions that also apply. So for most families trying to save a meaningful amount for education, the 529 plan is usually more practical. Now, let's go back to the original question we had at the beginning of the video. You have $5,000. Where should it go? Well, here is how I would look at it from a tax planning perspective. If the child qualifies for the $1,000 federal contribution, open the Trump account and claim it. That does not mean all additional savings must go there, but if an employer offers a qualifying contribution to a Trump account, that also makes the Trump account more attractive because the employer contribution can be excluded from the employee's current taxable income. For the family's own money, I would ask one question: what is the money mainly going to be used for? If the money is expected to pay for education, the 529 plan will generally have the stronger tax treatment. If the goal is to create long-term retirement wealth for the child and leave the money invested for decades, the Trump account may be more attractive. But you do not necessarily have to choose just one. A family could split the $5,000. For example, $2,500 could be put into the Trump account and $2,500 could be put into the 529 account. Or the family could fully fund one account one year and focus on the other one next year. A parent or grandparent may also contribute to a Trump account, a 529, and a Coverdell for the same child, as long as separate eligibility and contribution rules are followed. Those contributions may also count as gifts, so families should coordinate contributions and keep annual gift tax exclusions and possible gift tax filings requirements in mind. So here's the bottom line. The Trump account is potentially a powerful way to begin retirement savings before the child has any earned income. The 529 is generally the stronger tax account when money is expected to pay for education. And the Coverdell is another educational option with a lower contribution limit but potentially broader investment flexibility. There's no automatic winner for every family. The right answer depends on what you want the money to accomplish. So start with the goal, then choose the account whose tax rules best match the goal. And if you're looking for other ways to reduce taxes before year end, I have a free 5-step year-round checklist that you might find helpful. I'll leave a link in the description below, and if you can, please like and subscribe for more practical tax planning information. And I'll catch you on the next one.